Okay, let me first begin by commending my colleague Lori Hodrick for all the hard work behind the program for financial studies, as well as putting this seminar series together, which gives me an opportunity to be in front of you today. This is based on joint work that I have done with John Dye, who is a senior portfolio manager at Kaplan Investment Management, which is a fixed income relative value arbitrage hedge fund managing about $7 billion. Okay, so this is a nice takeoff point for me following what Professor Ken Daniel talked about. In particular, he talked about the long short kind of strategies in the context of looking at winners and losers. Now, when we think about risk of a hedge fund, we tend to focus on the style of the fund. Is it global macro, fixed income RV, long short, and so forth. So we then tend to focus on market risk, counterparty risk, what is the operational platform, and so forth. But the thrust of my research with John Dye is on the last two bullet points. What is the funding risk from prime brokers, and I'll be more specific about that, and redemption risk from investors. So let me try to give you a framework for thinking about this. So if you are a hedge fund, you could have a particular portfolio strategy associated with your style. It could be a global macro. You could take a bet on the direction of the market, or you could do long short and so forth. And associated with your strategy, there's going to be some market risk, counterparty risk, and operational risk. Most of the risk management tend to focus on these three items. But then if you ask yourself about the relationship that the hedge fund has with their investors, the investors could be institutional investors who could take a long-term perspective, or they could be fund of funds who could take a relatively short-term perspective, and sometimes these two investors are commingled, and they provide the capital to the fund manager. And the fund manager is expected to provide some alpha and returns net of fees. Okay. Now, keep in mind that these investors have certain rights. They have the right to redeem their capital by serving notice. And we can think of this in options parlance as the hedge fund manager being short an option. In other words, investors have a redemption option. They can pull away their capital, which means the fund manager has to delever, right, to return this capital back to the investors, prematurely shut down some of their portfolio transaction to meet the redemption needs. And we are arguing, well, this short position that the fund managers have is going to confine the leverage that they could take. It's a normative statement, right? And likewise, if you look at the prime brokers, what is the relationship between the prime brokers and the fund manager? Well, in order for the fund to take leverage, and going back to Professor Ken Daniel's point of view, well, if it's a long short fund, you're going to take a levered long position perhaps in winners, or you could take a levered short position in losers. That means you need the services of a prime broker who is prepared to extend his balance sheet to the fund. So the prime broker is prepared to give funds and securities. In return, the prime broker is going to demand some collateral and margins. Well, if you think hard about the behavior of the prime broker, and I'll give you some evidence on that, of course, the prime brokers have the right to change the terms of their funding, okay? Or they could even withdraw the funding in an extreme situation. Okay? We'll talk about that. That means that the prime broker is holding a funding option. Conversely, the fund manager, hedge fund manager, is short another option, right? If the funding is taken out, or if the haircuts or margins are increased, what does the manager have to do? They have to delever, right? That means they have to prematurely close out some of their portfolio strategies in order to meet the demands of the prime brokers. And that again suggests that it would have an implication for the leverage. What should be the optimal leverage for a hedge fund? Okay. So let's talk a little bit about the kind of the services that prime brokers provide to the hedge funds, right? They lend securities, they lend cash, allowing the fund manager to either take levered long positions or short positions, right? They're all collateralized. You have to post some margin in order to be in a position to take a long or short position. The terms of the collateral and the type of the collateral may reflect the market conditions and the fund's performance. Okay, so what do we get out of this? Well, we can expect the prime brokers to increase margins following poor performance, right? You can expect them to increase the margins in tight credit market conditions such as 2008, for example. And they may even specify performance triggers. What do I mean by this? If the rate of outflow or if the net asset value goes down below a certain threshold, the prime broker may say, we're going to shut you down. We're not going to provide any further balance sheet for you. We're going to take your assets, auction them off, and shut you down. Okay, so that's a very powerful option that prime brokers have. So we model this in this paper as a short position from the perspective of the fund manager. Okay, how if you are a smart fund manager, how should you think about this? Well, you know that in bad states of the world, margins may be increased and credit lines may be shut down. So you better put in ahead of time, anticipating this behavior on the part of prime brokers, you set some risk limits, right? If you have not set these risk limits, you're going to have to delever involuntarily, right? Because you're going to be forced to delever, and that can reduce the returns that you can come up with, right? So this argument would lead to a reduction ex ante in the leverage of the hedge fund. Now, what is the empirical evidence on this? This is a conceptual argument, and you might ask, well, do we actually see prime brokers behaving this way? And let me give you some anecdotal evidence, right? This comes from Bank of England, April 2008, March 2008, Carlyle, Peloton Partners, and Blue River Asset Management were shut down, primarily because of the actions that were taken by the prime brokers. Okay, that's of course an anecdotal evidence. What about the haircuts or the initial margins that prime brokers demand in order for them to extend the balance sheet? Look at April 2007 for different asset classes, right? So US Treasuries in April 2007 perfectly happy to provide leverage at 25 basis points, but in August 2008, 3%, right? But if you look at asset-backed securities, for example, 3 to 5% in April 2007, 50 to 60% in August 2008. But look at triple B tranche. They were essentially saying, no matter what you post as collateral, we are not going to give you any funding. Essentially, they were forcing them to shut down, right? So you can see that this funding option is not just a conceptual point. This is an important empirical point. If you are a smart fund manager, you can't take the funding that is provided by prime brokers as given. You have to assume that they're going to cut down the funding or make the terms of the funding extremely unattractive in bad states of the world. That means you've got to be very careful about the extent of leverage that you take, right? It also has implications at an individual portfolio manager level, right? It's not just aggregate leverage. If you have two portfolio managers within the fund, both of them doing very well, but one fund manager requires the use of the balance sheet of the prime broker, the other fund manager does not use that much of a balance sheet, then the manager who is using the balance sheet is subjecting the fund to this option, right? So the risk capital that you're going to be assigning to that manager has to be more expensive, right? That's one of the implications that will come out of our paper. All right, what about the redemption option? Well, of course, investors can pull away their capital. And how do hedge fund managers deal with this? Well, typically they will require a notice period, right? You've got to give a notice period of 30 to 90 days so that you can orderly liquidate some of your portfolio and be ready to meet the redemption requirements of your investors, right? And there may be redemption gates. Ex ante, you enter into an agreement as a manager with your client and say, look, in our fund, at any point in time, you cannot redeem more than 25% of your capital per quarter, right? That's an agreement that you sign off right at the beginning. And that kind of a gate could be either automatic or it could be left to the discretion of the board of the hedge fund. And then there could be lockup periods. Institutional investors who are very comfortable about the reputation of the manager may say, we are prepared to give you capital, lock it up for 2 years. right, then you're reducing the value of this redemption option. But if you think about a commingling problem, if you're taking money both from long-term investors who are prepared to lock up and taking money from fund of funds who want to take the money anytime they want, then you create a problem, because you're providing liquidity to fund of funds at the expense of the long-term investors. So the long-term investors would then say, well, you cannot accept money from fund of funds unless you exact some kind of a concession from them. So you'll only say, well, short-term investors can take the money out, but they have to pay a fee of 6% or 7%, and this fee would be credited to the remaining and continuing investors. It doesn't go to the fund manager, it goes to the continuing investors. So you can see here, these options are going to be very important in thinking about the contractual design and in thinking about the leverage. Again, some evidence on how serious was this redemption. Sometimes people say, well, many hedge funds put in the gates. They wouldn't allow their capital, the capital of the investors to be redeemed. But you can see that despite the presence of the gates in 2008, close to $300 billion were redeemed from the hedge fund industry. So this is again very powerful option that hedge fund managers are short. All right, so how do we think about modeling this? Okay, I'm going to give you a little bit of a flavor of the model. The way we model this is say, well, there is a threshold level of pain that investors and prime brokers are prepared to accept. And in this example here, it's minus 20%. It could be as low as minus 5%. So if there's a poor performance, up to minus 20%, prime brokers are not going to increase the haircuts. Investors are not going to redeem the capital. Think about it that way, right? And over time, if you take a lot of leverage and you are producing good returns, the returns are going to be magnified, and then at the end of a horizon period, you're going to collect your fees, you're going to keep the upside, right? And so that's fine. On the other hand, if with high leverage, if the realization is bad, either because you made poor bets or because there was a credit crisis or something like that, then you're hitting the threshold level of pain. That means prime brokers are going to step in, they're going to increase the margins, investors are going to demand their capital back, and you get shut down. And when you get shut down, the deleveraging cost depends upon the style of your portfolio, the underlying liquidity of your portfolio, so the leverage would be influenced ex ante by those considerations as well. So let me give you a just illustrative example of three styles, right? At the top row, you have CTAs, which is commodity trading advisors. They primarily hold futures portfolio, right? So they don't take leverage through prime brokers. By engaging directly in futures contract, they're taking leverage through futures contract, so they don't have any funding option to worry about, right? That means they can take more leverage to the extent that the underlying futures contract is through a centralized clearing house. They don't have to worry about prime brokers increasing the margins. Of course, exchanges could do the same thing, but by and large, the exchange behavior seems to be more predictable than the behavior of the prime brokers. The second observation is that, well, futures contracts are quite liquid. That means the deleveraging cost need not be very high. Even if investors demand the capital back, quickly you could liquidate the futures contract. They're mark to market on a daily basis. So if you combine these two arguments, we could say, well, maybe the leverage of CTAs could be quite high. Doesn't mean that they're necessarily risky, right? Perhaps if you are a CTA manager, you may not require gates or lockups because you're in a position to meet the funding requirements or the redemption needs of your investor because of the liquidity of your underlying portfolio. If you're a fixed income relative value arbitrage fund, then of course you're relying on your prime brokers. You're going to do repo and reverse repo transaction, so you need the balance sheet of the prime brokers. You're relying on spreads, and you could be in an illiquid part of the fixed income, so deleveraging costs could be very high. So you have to deal with these questions quite explicitly. That means the leverage that you could take should reflect the market liquidity and the strength of the prime broker and investor agreements that you have. Right? That's something that's going to be very important if you're a potential investor in this hedge fund. Not only you worry about the portfolio style, you ask yourself what kind of prime broking agreements the fund manager has, right? What kind of investor agreement the fund manager has, and that will allow you to judge whether these are good agreements, allowing this manager to produce the appropriate alpha for the investors. Likewise, we could say similar things for the long-short style as well. Okay. Now, I'm going to show you a few pictures that sort of summarize the conclusions that we draw from our paper. So I just want to give you a flavor of the results of the paper. So along the x-axis, we are plotting market risk. What do we mean by market risk? It's leverage times the volatility of the underlying fund. Okay? Both of them are combined in the market risk. On the left y-axis, you have the expected return. On the right y-axis, you have the exercise probability. What do we mean by this? This is the likelihood that either the funding option or the redemption option would be exercised. Okay? So as you try to take higher and higher leverage, you could see that this funding option and the redemption option goes deeper in the money. The red line refers to a fund manager with a Sharpe ratio of 1, and the blue refers to a fund manager with a Sharpe ratio of 2. What does this graph attempt to convey? Well, notice that the fund manager with a high Sharpe ratio is able to take on higher amount of leverage, right, without necessarily increasing the probability that this funding and the redemption option would be exercised. On the other hand, the fund manager with a Sharpe ratio of 1, he couldn't take too much leverage, because if he takes too much leverage, the option could be exercised against that fund manager. So the first observation here is that the reputation of the fund manager in order to be able to deliver alpha to the clients is going to be an important consideration in the amount of leverage that the manager is in a position to take. I had mentioned earlier, deleveraging costs is going to be very important. Many fund managers found out in 2008 what they assumed to be highly liquid strategies turned out to be exposed illiquid. And they were forced to delever precisely under the same circumstances when others were delevering, making the deleveraging cost extremely high, right? So if you look at, again, example, you have a fund manager who is operating in a style where the cost of deleveraging is very high. What would be an example of that? Structured credit, for example, as opposed to working in G3 fixed income, right? So if you think of G3 fixed income, there's a low cost associated with deleveraging, whereas if you think of structured credit, very high cost associated with deleveraging. So you can see that leverage is going to be reflecting the cost of deleveraging ex ante. What about the prime broking agreement? If I have worked out a very good prime broking agreement which gives me evergreen funding, right? I get term funding, I get very good haircuts because I've been in the business for 5-6 years. I got very good agreements with the prime brokers. I have multiple prime brokers. On the other hand, in my style, there is another manager who doesn't have the same kind of a prime broking agreement. Then you're going to find the leverage differences could reflect that advantage that the manager has with respect to the prime broking relationship. So that's going to be another important thing that you need to look at as an investor. I want to talk a little bit about margin multiplier. This turned out to be a very important consideration in 2008. The fund manager, when they're evaluated by the prime broker, they are given some rating, and according to the rating, a margin multiplier is applied. If you are a very good fund manager in the eyes of the prime broker, you get a low multiplier, right? If you are really perceived to be a questionable fund manager, you may not get any funding, but if you get funding, it will be at very unattractive terms, which means your margin multiplier is going to be very high. So if you try to take too much leverage and your multiplier is really high, then you're putting more and more of your capital as collateral. That means you have very little unencumbered cash left with you, right? Now, unencumbered cash is a transparent number that you can actually demand as a potential investor. As an investor in a hedge fund, by looking at the unencumbered cash, you could tell right away whether the leverage is high or low, right? If the fund is holding 80% of the assets under management as unencumbered cash, then it's only putting 20% as margin to take leverage, right? So that's going to give you right away some information about the leverage that is taken by the fund. I'm running out of time, so let me just make a couple of very quick points. One of the implications of the paper is that from the investor's perspective, as important as it is to judge the portfolio style and the risk management capabilities of the hedge fund manager, it is just as important to understand the relationship that the fund has with prime brokers and their investors. That's the first point. The second point is that when there is deleveraging that occurs on an industry-wide basis, actually it is probably good that there are gates, there are notice period, and there are other circuit breakers that are present, because that is going to prevent the occurrence of a contagion. Sometimes you get the perspective that these are bad things to have in the fund contract. Let me just show you one. If you look through the crisis through 2007 and 2008, you have the net. There was a whole lot of deleveraging that was going on, right, in the industry. This is from Morgan Stanley Prime Broker. But if you look at the yellow bars, they represent the unencumbered cash. Now, if you are doing voluntary delevering, then dollar per dollar, your delevering will translate back into cash increase in cash balance. But if you're doing involuntary delevering, then you're not selling these things at the right price. Your cash balances may not go up as much. So one of the ways in which you can tell whether a fund manager is doing a good job, is strategically reducing the leverage, or he is involuntarily reducing the leverage, is by looking at the unencumbered cash balance. Let me stop here, and I'll be happy to address your questions later.